Everyone is talking about the private credit bubble. I'm going to explain it to you in 5 minutes or so. What is it, why you should take it seriously, and how to survive the fallout. Private credit is a global $3.5 trillion industry on the verge of collapse. And if it goes, it could take AI with it, which is an $8 trillion industry. So we're talking about 11.5 trillion in one hit, making it far bigger than 2008. Yet the mainstream media is telling you that private credit is perfectly safe. Is it actually safe? We're going to answer that today. My name's Nick. I've been a professional investor and unprofessional trader for 24 years. Before I start, I'm not a financial advisor. This is not an inducement to buy or sell any assets. And most importantly, do not take financial advice from some random dude on YouTube. I'm going to slow down now. Don't worry. Just wanted to get through the disclaimer fast. Okay, so let's get started. What is private credit? After the 2008 disaster, the financial disaster, regulators made it expensive for traditional banks to hold corporate risky loans or to even give out these loans. They made it very hard. So the banks retreated. But those risky mid-sized companies still needed money. They still needed loans. So alternative asset managers stepped into the shadows to fill the void. And I say the shadows because this became known as shadow banking. Think BlackRock, Blackstone, Morgan Stanley, and many others. They took retail money from wealth management platforms and lent it directly to these companies that banks were no longer allowed to touch. And they also convinced retail to pour in more money by bragging about how much yield private credit offers, 10 to 14% returns with almost zero volatility. Basically, the messaging was that this is a perfectly insulated market and that borrowers are fine, right? They're perfectly safe. Inexperienced investors saw those double-digit yields and they piled money in through semi-liquid funds. Many did so knowingly, so you could argue for them it's their fault, no problems. But the problem is, many had their financial advisors or asset managers invest on their behalf. So a lot of people have exposure to private credit and they don't even know it, especially through their pension funds, which is the scariest thing. Why does Wall Street love it? Because these retail products set up the perfect trap for Wall Street. Let's talk about why this illusion is breaking and what the smart money is actually doing right now. Look, the reality is that private credit funds don't trade on public markets. They use a model called mark-to-model accounting. Let me translate what that actually means for you. It means the fund managers make up the value of the loans themselves using internal spreadsheets. I'm sorry, I shouldn't laugh. It's just crazy. It's crazy. It's crazy what Wall Street gets up to, right? They report loss rates below 0.1%, while the public credit market is actually seeing default rates of around 4.5%. But the truth is right there in the data. Fitch Ratings just reported that the actual default rate for US private credit hit a record 9.2% last year. And the big banks know the numbers are fake. JP Morgan just started marking down the value of private credit loans used as collateral. In one specific case, BlackRock was carrying a loan at 100 cents on the dollar, which obviously 100 cents is a dollar. 3 months later, they abruptly marked it to completely zero. Even Apollo's own head of credit, and they're a private credit lender, by the way, literally said that he thinks all the marks are wrong. When insiders admit that the numbers are fake, what does that mean for your money? In Europe, private credit lenders quietly took control of roughly 150 companies since 2017 because the borrowers couldn't pay their debt anymore, so they basically repossessed the companies. Only 4 of those companies ever went public. They just take the keys and pretend everything is fine. But maybe this is just an isolated issue, right? No, not really, because this ties directly into a massive liquidity mismatch that perfectly mirrors the 2007 subprime mortgage crisis, which led to the 2008 collapse. Let's look at what happened back then because it's important. It's a parallel. Wall Street took highly liquid mortgages and packaged them into AAA rated bonds that look safe, right? When the underlying borrowers started defaulting, the illusion of liquidity vanished instantly. The underlying mechanism today is exactly the same. Today, they are taking highly illiquid corporate loans and packaging them into retail funds that promise quarterly redemptions, AAA rating, all good. It's all safe, right? It's the exact same disease, but it's in a different wrapper now. And here's the bigger problem. The quarterly redemptions windows are capped at 5%, which means, let's say one of these private credit companies manages $1 billion of retail money. They all manage more than that, but it's an easy number to work with. With quarterly redemptions capped at 5%, retail can only ever withdraw 50 million per quarter, let's say. I'm simplifying a bit here, but you get the idea. This works fine when markets are doing well and no one wants their money back. But when everyone is rushing for the exits because the private credit bubble is popping, well, then it becomes a problem, especially if your financial advisor has put you into these without you really understanding what's going on and now your money is trapped. In the first quarter of this year, 6 major firms cracked. BlackRock gated withdrawals after getting hit with 1.2 billion in redemption requests in one quarter. Morgan Stanley froze retail accounts, returning less than half of what investors asked for. Blue Owl permanently closed redemptions on a $1.6 billion fund and started liquidating assets. Apollo locked up a $15 billion flagship fund, handing investors roughly 45 cents on the dollar for requests over the cap. They are perfectly happy to trap retail investors in these failing funds while they figure out how to offload the risk, allegedly. But the scariest part of all this is that major private credit lenders, especially BlackRock, are trying to prop up this dying industry with hardworking Americans' pensions. Last year, they lobbied aggressively for Executive Order 14330, so 14330. This order eases restrictions so that they can put private credit directly into everyday Americans' 401k plans. They are dumping their toxic, illiquid mistakes directly into your retirement account to bail themselves out, allegedly. Actually, not allegedly, because the executive order exists. It was signed by Trump, right? Check it out. The executive order is called Democratizing Access to Alternative Assets for 401k Investors. Beautiful name, but you know. So to summarize, since 2008, banks have not been allowed to lend to risky borrowers. Private credit stepped in to fill that gap. They lent retail money to small, mid-sized companies looking for loans. They promised retail 10 to 14% yield. Now those companies are failing because the economy is struggling. Retail wants their money out, but redemptions are now capped at 5% per quarter, or they were capped anyway. That was the contract they signed. But not everyone knew that they were getting into this. The whole private credit system is currently collapsing. BlackRock and friends are desperately trying to prop it up with even more retail money through 401ks, and Trump's executive order is making it possible. What does that mean for you? Look, it's simple. Ask your pension advisor or your financial advisor if you have exposure to private credit. If you do, and you're not comfortable with that, try trimming the exposure. Just talk to them about it, get professional advice. If you want more of these 5-minute breakdowns on these complex topics, drop a comment below. I know this one might have went over 5 minutes, but close enough. I'll see you in the next one.